When you're looking at the stock market, you're just drowning in numbers, right? But what if I told you that some of the simplest, most common numbers we all look at are actually designed to mislead you? Well, today, we're going to pull back the curtain on 3 big stock market myths that could be costing you real money.
So the big question is, are these numbers, the ones we see at a glance, actually telling us the truth? We're about to put 3 key metrics under a microscope. We're talking dividend yield, face value, and promoter holding. Let's find out what they are really hiding.
All right, first on our list, the dividend. Ah, yes, that lovely little payout that shows up in your account. But what if I told you that attractive number could actually be a trap? Let's take a closer look. Yeah, this is what everyone thinks, right? A company that pays a high dividend must be stable, it's profitable, it's sharing the wealth. It feels so safe, kind of like a guaranteed bonus. But this belief misses a massive piece of the puzzle.
Okay, so check this out. This slide really lays it all out. On one side, you've got a company like Coal India. It's paying out a big dividend, over 5%. Why? Because it doesn't really have a ton of places to put that money to grow aggressively. It's basically telling you, hey, we don't have a better idea for this cash, so you might as well take it. But then, look at the other side, a growth machine like InfoEdge. The dividend is tiny, because they're taking every last rupee and plowing it back into the business, for more growth, for new projects to stay ahead of the game.
And here's where the rubber meets the road. This chart shows you exactly what happened. Sure, that dividend from Coal India might have felt nice in the short term, but look, over 5 years, the actual stock price went down. Meanwhile, InfoEdge, the company that held on to its cash to grow, saw its share price explode upwards. See? The dividend told one story, but the real money was made in a completely different one. And hey, if you're still not convinced, just look at the master himself, Warren Buffett. His company, Berkshire Hathaway, almost never pays a dividend. His logic is just so simple. Why would I give you back $1 if I'm confident I can turn it into more than $1 by putting it back to work in the business? Sometimes a low dividend isn't a red flag at all. It's a massive vote of confidence from the people in charge.
Okay, let's move on to myth number 2. And honestly, this one is a classic trap, especially if you're new to investing. We're talking about face value. So what even is face value? You'll see it listed for every stock, but what does it mean? Well, it's basically a fossil from the old days, a relic from when you'd get an actual physical piece of paper as your share certificate. It was just the nominal value printed on it. The key thing to remember is this: it's an accounting term, not an investing one. And this is where people get totally tripped up. They'll see a stock with a face value of, say, 10 rupees, and it's trading at 12 rupees. And they think, whoa, it's a bargain. I'm getting in near the original price. That is a huge mistake. This comparison just blows that whole idea out of the water. Look at this. You've got MRF and another company, DNL Labs. Both have the exact same face value, 10 rupees. But one share of MRF will set you back around 66,000, while the other costs less than 3. This proves, without a doubt, that face value has zero, and I mean zero, to do with what a stock is actually worth today.
I absolutely love this analogy. It just makes everything click. Think about it. Is 10 grams of iron worth the same as 10 grams of gold? Of course not. The weight is identical, but the value is worlds apart. That's face value. It's just the weight, not the actual worth of the company.
All right, let's get to our third and final myth. Now, this one's a little more advanced, but trust me, it is so important to understand. We're diving into promoter holding. So what is promoter holding? Simple, really. It's just the slice of the company that the founders, the owners, the main management team still owns. And the logic seems solid, right? If the owners have a big stake, skin in the game, they must really believe in the future of their company. But that single number can hide some really ugly secrets. So you're doing your research, you pull up a stock, and you see this number, 57% promoter holding. And you think, hey, that's pretty good, right? That's a solid number. You might be tempted to just stop there, give it a check mark, and move on. But you can't. Because lurking just beneath that nice-looking number is this: pledged shares. What does that mean? It means the promoter has basically taken out a mortgage on their own shares. They've used them as collateral for a loan. And in this case, a massive 82% of that strong holding is pledged. That doesn't exactly scream confidence. It kind of screams financial trust.
And it doesn't even stop there. There's another secret you have to uncover. A single number, a snapshot in time, it's not enough. You've got to look at the trend. Is that promoter stick going up, or is it going down?
Just look at this. Quarter after quarter after quarter, that number is dropping. It might be tiny amounts, but it's a clear, steady pattern of selling. So now let's put the two pieces together. Not only have they mortgaged most of their shares, they're also slowly selling off what's left. Suddenly, the story completely flips from confidence to major red flag.
Wow, okay, so let's recap. We've just torn apart 3 huge myths. We've seen how a high dividend can be a bad sign, how face value is basically useless, and how a high promoter holding can hide some scary truths. So the question is, how do we actually use this to be smarter investors?
Well, here it is. This is your new mental checklist. From now on, whenever you see a high dividend, you're going to ask why. Is it a growth problem? When you see a promoter holding number, your very next click is to check for pledged shares. And finally, you're going to look at the trend over time. Are the insiders buying more, or are they quietly heading for the exit?
And really, if you remember only one thing from all of this, let it be this. A number by itself means absolutely nothing. You have to understand the context, the why, the story behind it. The goal isn't just to see the numbers, it's to read the story that those numbers are trying to tell you.
So I'll leave you with this thought. Armed with this knowledge, the next time you're about to invest, are you just going to be fooled by a simple number? Or are you going to be the one who digs a little deeper and sees the full story?